Welcome to Scalpers University Module 2, Systems and Execution, Lesson 3, Statistics and Probability. So, in this lesson, we're going to cover the basics of statistics and probability. We're not going to get too mathematical with it. I'm going to try and keep it in a very easy to understand format because the whole core philosophy of Scalpers University and of my trading style in general is to remove as much noise as possible and keep things as simple as we can. For example, we have an infinite number of outcomes that can happen in trading or in the markets, really. Even though technically you might be able to say, oh yes, there's only a certain number of, Bitcoin can only go to, it goes up in $1 increments and it can only go so far in a certain time frame. Yes, theoretically it can go to infinity, but let's say it's not going to go above 100,000 today whenever it's at 43k. Okay, so but even still that leaves us with an enormous number of possible outcomes because each $1 increment technically represents another outcome, and then the number of variables that impact that are again innumerable. We have just a rogue buyer or seller who decides to dump or buy a lot can cause price movements. You can have major economic news, major political news, wars, bullish news, bearish news, whatever it may be, that can affect the psychology of the market in the short term and make price move. So we want to cut out all that noise and just focus on the probabilities and the statistics as it relates to a system that you are running. Okay? I like to say the price includes all of the news already. People tend to say it's priced in. I don't believe that every possible scenario is always priced in, but I do believe that whatever gets printed on the candlestick is an amalgamation of all known information at that point. So when you look back and you're testing a system, and you might say you back test it, which is where you look at previous data and run it on your whatever system it may be. Let's say something very simple. You say RSI, when it hits 30 on the daily, I will buy. And you go back and you back test every time that the RSI hit 30 and you buy. You can figure out the probability of that being a profitable trade or an unprofitable trade. And so the candlesticks that you're using back then and the indicator that touches 30 on the RSI, that also was subject to the same infinite number of possible scenarios. Yet we got the scenario we did. And so you can say that the previous data does account for all news. And you can also say then that future, if you're going to forward test and you're saying that the future data, the future candlesticks that we printed on the chart, they will also behave in the same way. So to introduce to stats and probability, I want to talk about the most common cognitive bias that affects traders, which is the gambler's fallacy. So rule number 28 of Scalpers University is always remember the gambler's fallacy. This is something that affects us all, whether consciously or unconsciously, and the idea here is to make that conscious for you. The gambler's fallacy, it's the incorrect belief that if a particular event has occurred more frequently than normal during the past, usually during the recent past, that it's less likely to happen in future. Right? So the coin toss example is a common one. If you just not a biased coin, a coin that is 50-50, it truly heads or tails could be 50-50, and someone manages, you flip heads 9 times, most people will tell you that they would go for tails on the next toss, or that tails is more likely to come up on the next toss. That's the gambler's fallacy. So you have to remember that each of these events, because of their independence, are referred to as statistically independent. So the toss of one coin does not have any effect on the toss of the next one or the one thereafter. Same thing in trading. One trade does not have any bearing on the next trade or on the previous trade before it. You'll remember a previous rule from Scalpers University that each trade exists in a vacuum, and that's exactly what we're talking about here. There's also an interesting spin or flip on the gambler's fallacy that's very important in markets. So the typical belief of the gambler's fallacy is that if you continue to flip heads, 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 you're going to think it's more likely to be tails. In trading, and especially in the crypto markets, there is a reflexivity that actually creates the feeling that when a price is going up and up and up and up, that it's going to keep going up, and traders therefore look for longs when they should be looking for shorts, and vice versa. So this is quite a unique situation, because if you took any other discrete trading or any other discrete gambling opportunity, typically people would lean the other way. Even at roulette, let's say someone's on a hot streak or whatever and it's red keeps coming up, they don't have any inherent bias towards red. They don't really have as much of their actual worldview contingent upon red coming up. Does that make sense? So if you're in a casino and you're gambling on roulette and red keeps coming up, you're not going to say, well, I'm going to keep gambling red just because I believe red's the best. Red's the greatest. There is no other color like red. Red's the greatest color that's ever existed. Red's the future of all colors. You're not going to say that, are you? But in the markets, and especially in the crypto markets, when coin goes up, especially like Bitcoin, it keeps going up and up and up. You get all the maxis coming out. And even like people like us, we all want it to go up, don't we? Because we all get richer. And so you start looking for reasons of why it will keep going up. So it's just a unique kind of thing to these markets that you want to be aware of. And it's something to keep in mind when you are aware of the gambler's fallacy, but also you can just flip that and say, okay, I want to also be aware that I don't want to fall into that cognitive trap of essentially being a maxi. And don't forget that that happens on the other side as well. Because even when it starts going down, even though you want things to go up, you get hit with the reverse feeling. Because as it goes up and up and up and up, and you get richer and richer and richer and richer, you keep expecting it to go up, you keep looking for longs, because you get greedy. As it goes down and down and down and down, even though you don't want it to go down, you start your mindset flips to negative. You start seeing how much money you're losing. You think, I'm always going to be losing money, and you expect it to continue going down, and maybe you start to short, or you panic sell, or you capitulate. So take those two biases along with each other. That was just a little side note on it. That's a very important thing to think about when you're specifically looking at the markets. And if you see the chart that I have on the screen, that very, very peak and that little dip from it and the small bounce we got was the most bullish this market has ever been. And in hindsight, of course, everything in hindsight's easy, but in hindsight, it's almost laughable, because you look at it and think, of course, yeah, we had a long uptrend. We had a little bit of a sideways move here, and we had a break up, a drop, and then a bounce. People want to believe that this is the next stop before 100, because what they'll say is this red line, which was previous resistance, came up here, resistance, broke it, held as resistance, came above, and look, we flipped it to support, and that's an excuse to go long. Same as you can see all the way down, when we're breaking through supports, it looks like we're never going to stop breaking through supports, and of course eventually we do find a bottom and we pump. So looking at it now, we'll take this into a more practical sense, and we'll look at one of my favorite examples, the coin toss experiment. So this actually comes from a study, and it's a study highlighting something called the Kelly criterion, which we'll get into in module 2, lesson 4. which deals a bit more with position sizing and execution. But essentially, in a study, a group of participants were given $25 and told to place bets on a coin that would land on heads 60% of the time. The bets were even money, meaning if you bet $1, you can either lose that dollar or you can win one extra dollar. They had 30 minutes to play, which gave them time to place around 300 bets, and the prizes were capped at $250, so they could 10x their money. And the crazy thing is the results of this study is that 28% of the participants went bust, and the average payout was only $91. Remember, they started with $250. Only 20% of the participants, only 1 in 5, actually reached the maximum of $250. 18 out of the 61 bet everything on the first toss, and amazingly, 2/3 of people gambled on tails at some stage in the experiment. And if you recognize what that is, that's the gambler's fallacy. So it's pretty amazing to think that only 1 in 5 managed to reach the maximum in a study where they had literally a weighted coin, a biased coin in their favor. And the fact that more people went bust than reached the maximum, and also that 2/3, so 66% of people, actually went on tails. So they actually bet against themselves. 66%, two out of every 3, at some point picked tails when it was 40% likely, and heads is 60. The worst part about this is that these were actually math and computer science graduates, many of whom are working in trading within the financial world. These weren't people just picked off the street. They were picked as students, graduates of universities, dealing with this exact field, or at least an adjacent field, either math itself or computer science. And it shows that the cognitive biases that we have as humans are stronger than anything you can learn. Many suffered still from the gambler's fallacy, trying to be smarter than the game itself. 2 out of every 3 tried to guess tails, and no doubt that was because they'd flipped 7 or 8 heads in a row. And to me, what it means is, 1, people are stupid. But 2, in a more practical sense, that makes me very confident about my trading and more confident about my future success within the markets. Because that's the people you're trying to beat. And even that's not even the people you're trying to beat. Those are supposedly smart people. You're gambling against, well, not gambling, you're trading against people who are even stupider than that, who don't even understand probabilities at all, and would probably just fall into the gambler's fallacy, all the time, or just generally blow themselves up by doing what some of those guys did, which is betting everything on one toss. Now, we'll get into that in a moment. Betting everything on one toss is not necessarily wrong, but we want to work out, in any experiment like this, you want to understand how is the best way to actually play it. Because if I give you that coin and told you to flip it, you had $25, would you go bust? How much would you bet? And that's the most important question. Should you bet at all? Should you bet part of it? And so we'll get into that in a later part of the lesson. So rule number 29, respect the law of large numbers. On the screen, with definitions, 2 important definitions, which are probability and expected value, or EV. The probability of something is just a numerical description of how likely an event is to occur. Okay, so coin that's not weighted, just a regular coin, the probability of heads is 50%, 0.5, however you want to visualize. Yeah, the description numerically of how likely heads is to occur is 50%, 0.5. Expected value, which is the most important concept that we're going to talk about with regards to stats and probability within trading, is the anticipated value for an investment at some point in the future. Okay, so let's go to the rolling a dice, for example. The expected value in rolling a dice is the weighted average of all possible outcomes. All right, so if you have a finite number of outcomes, which a dice rolling a dice does, the EV will always be a weighted average of all possible outcomes. The markets are more complex than rolling a dice because there are a large number of possible outcomes and it's hard to assign a probability to them. But in essence, it's the same. A six-sided dice is easy, of course. Each side has a 1 in 6 chance of landing, and you cannot have any other outcome apart from a 1, 2, 3, 4, 5, or 6. So you've got a 0.166% or a 0.16. Is your probability, because that's 1/6 of a whole one. And so from that, you can deduce the expected value of each roll. So if you're going to be betting on 1 every time, or whatever your chosen number is, you can figure out what the probability is over a large enough sample set that you will win, and then you can position size based upon that. There's two focuses of expected value, or personally for me, how I use it, is one, to figure out whether there's a potential edge, whether the trade itself can even possibly yield me a positive return. And then two, it's to help me figure out how to position size. Because everyone, especially in the markets, they either through laziness or through fear, they just default and say, "Oh, the markets are, you know, they're fine. They're so big. They're so infinite. Like how can I assign an expected value to a trade whenever Bitcoin could go up, down, sideways? It can go up in $1 increments. It could go up a little bit, but then down. It could go down a little bit and then up. Where do I put my stop loss? But they get themselves all worked up. But everybody plays the same game, and this is again where we're bringing it back to being simple. It doesn't matter that there's a quote unquote infinite number of different ways that Bitcoin could go. It could go up, down, or it could go straight up, it could go straight down, it could go up, down, up, down, up, down, up, down, it could chop. Everyone's playing the same game. So you are not at an immediate disadvantage in the markets. So get that victim mentality out of your head if you think you are. Now, of course, some funds and, well, all funds and all market makers and all prop traders, they have more sophisticated models than you, they have access to better data than you, etc., etc., etc. But at the end of the day, there's always a person behind that executing it. And people can always fall to cognitive biases. And also, you're trading against retail. The whales are trading against the whales, and the market makers are trading against everybody. But really, over time, you're trying to find a positive expected value system plus EV and then allow it to run for a large enough sample size to benefit from those positive expected returns. Okay? So, a simple calculation that we have on the screen. The expected value of any trade is the probability of winning multiplied by the reward for winning minus the probability of losing multiplied by the risk of losing. All right? So, to show you that, we'll visualize it a little bit.